Good morning, Bitcoiners. Hello, and welcome back to your economic calendar with the information you need to start the week off right in Bitcoin. As always, I'm your host, Mauricio Di Bartolomeo here at Ledn, and today is Tuesday, December the 20th. So as we approach the Christmas holidays over the weekend, we wanted to wish everybody celebrating a happy holiday season. We hope you get to enjoy some quality time with your family after what has been some rocky weeks in the markets for sure. In today's issue, we're going to focus on a couple of things that you will likely start hearing more about in the next year. And those two things are the U.S. Treasury General Account and the U.S. debt ceiling. And we're also going to get into how those two things could impact Bitcoin prices and markets in general into the new year. So grab your coffees. It's going to be a great one. And starting as we usually do with Bitcoin, let's check in quickly on last week's price action. And we see that Bitcoin rose on the back of the CPI print on Tuesday, but gave everything back and then some after the Fed meeting on Wednesday, which again was something that we called in last week's BEC, that given the market reaction to the CPI print, the Fed could very likely come down and try to talk markets down during the press conference. Because again, a rally to end the year is the last thing Jerome Powell wants to see. And we saw a similar price action on the S&P 500. So it wasn't just a Bitcoin issue. This is really, the Fed is really trying to talk down all asset prices. But we'll get into that in a second. Let's go into today's analysis briefly. All right. So in today's analysis, we're going to talk about the Treasury General Account and the debt ceiling. So let's get into that. And to give a bit of background, every government needs to have a bank account from which to issue and receive payments. In the case of the US government, this bank account is referred to as the Treasury General Account. And we're going to dive into what that is. But you may have heard the name before. And today we're going to talk about why it matters to Bitcoin price. So as I mentioned, the Treasury General Account is controlled by the US Treasury Secretary. And that is Ms. Janet Yellen right now. So let's open up the balance for that checking account. So as you can see, the U.S. bank account, the U.S. government bank account, like everyone else's bank account, goes up and down over time in terms of the balance. This here is what you can see, the balances from 2011 into today. Now, while the balance historically has gotten close to zero, as we see in several instances, it never actually has touched zero or gotten to zero. And that's because the U.S. is always able to borrow money when the checking account balance is running low. And to illustrate that, we're going to look at the levels of the public debt in the United States. And the chart is pretty evident. Every gray area here on the chart is a recession, and no surprise, as you can see, when recessions hit, typically the debt becomes larger. Now, as the data shows, the US government has become progressively more indebted over time. And to take a look at how the debt levels interact with the general account balances, here are the two lines basically stacked on top of each other. So as you can see, they're both basically moving slowly upwards and to the right. Now, being the responsible government that the US is, the US Congress enforces a limit on how much debt can be taken out by the government. This is the debt ceiling. And you've probably heard about this already, and that limit currently sits at 31.4 trillion. Now, for historical context, the debt ceiling was first instituted in 1917, and during its 100-year plus history, the debt ceiling has been increased at least 90 times. So remember Ms. Yellen, who runs the bank account balances? This headline on your screen says, and it's from November 12th, so it's over a month ago, Ms. Yellen started warning about the need to lift the debt ceiling over a month ago. Now, even though her balance is currently sitting north of 500 billion, she sees the writing on the wall and has been increasingly outspoken about the need to increase the debt limit. The current public debt is sitting at, and we're going to show you this, it's sitting at $30.9 trillion. And that limit is just $500 billion away. 31.4 minus 30.9 is $500 billion. So she knows she will be tapped out soon if her limit isn't raised again. This is important to Bitcoin prices for two reasons. Number one, Ms. Yellen having a balance on her bank account north of $500 billion and her ability to keep spending that balance keeps injecting liquidity into the US economy. And this liquidity helps all asset prices ranging from the S&P 500 to Bitcoin prices to real estate. The second reason why this is very important is because the process to increase the said debt limit is a very big political dance in the US Congress. And that is the topic that we're going to talk about right now. Now, in 2023, the political dance around increasing this debt limit could impact markets. And as we can see from the headline from CNN, you're already starting to see inklings of this potential issue down the pipes for 2023. And we'll get to see some more inklings in a second. Now, let's start with touching on the first point, which is the liquidity aspect that we referenced. As with anybody or anything or company ready to spend $500 billion in any economy, Mrs. Yellen's spending is a big driver of liquidity for markets in general, as we just said. And once her payments hit the street, it usually boosts the US economy. And again, that money finds its way one way or another to equity markets and asset prices eventually. So drawing down the Treasury General account is generally a tailwind for markets and asset prices. Now, with the Federal Reserve, as we've touched on previous issues, which is programmatically removing liquidity from the system via its interest rate hikes and via its bond sales, Mrs. Yellen's spending becomes a key driver to keep markets at bay for the early part of 2023. And she'll be very likely looking to deploy her cash within that first quarter of 2023. And we'll get into the implications for Bitcoin prices next year shortly as we wrap up this section. Now, while her spending could provide some support to markets and equity prices in 2023, her balance will eventually get depleted. Which brings us to point number 2, the political dance to increase the debt ceiling in 2023. And to hear some more inklings of this issue, this is the New York Times basically saying that leaders back away from raising debt ceiling, punting clash to new Congress. The new Congress starts early in 2023. And we'll get into that in a second too. Now, for further context, the Republican Party has control of the US Congress in 2023, and the Democrats control the Senate. This divided power or divided houses sets the stage for a political battle that could take some time to resolve as both parties hold the majority on 2 different chambers of the US government. Now, each party will try to posture to get what they want, and their antics could spill into market volatility. Now, in short, the TGA spending or Treasury General Account spending will provide or could provide some volatility for markets in early 2023. But that stability could be very short-lived as the debate around the debt ceiling moves to the public forum. Right now, you see that it's very few sporadic headlines here and there, but this will become a major narrative. Now, to close out this section, let's go back to Mrs. Yellen and explore this idea that the US government can just borrow indefinitely when the Treasury General Account balance drops. While this is theoretically true, there are practical implications in the real world. Nobody, the US included, can borrow indefinitely without paying the price. To understand this better, let's use an example. Let's say that Ms. Yellen needs to top up her bank account. What she'll do is she'll request the issuance of a US Treasury bond, which can be issued ranging from maturities to 4 weeks to 30 years. And this bond will then be tendered to the market to see who wants to buy it. Now, let's say that Ms. Yellen needs $10 million. She will then offer a $10 million bond to the market at a 1-year maturity, just for this example. Now, because the US government debt doesn't typically include an interest payment, the interest rate for that bond is determined by the cash payment on the purchase of the bond relative to the notional or face value of the bond. For example, people could bid $9.8 million to buy a $10 million bond that pays out $10 million in a year. If they do that, the implied interest rate for this bond would be around 2%, which is $200,000 divided by 9.8 million, which is approximately 2%. Now, as people bid less or a lower price for the bond, the implied interest rate increases. Because the Federal Reserve wishes to maintain a consistent interest rate across all government bonds, it may not want interest rates for a particular bond to go a certain price level. In other words, it doesn't want, or it wants to set a minimum price that needs to be paid for those bonds to keep the interest rates in check. When the Federal Reserve sees that buyers are not showing up and bond prices are causing real interest rates to spike, it intervenes. The central bank intervenes. And the way it intervenes is by stepping up and purchasing the debt directly from the US government. Now, over time, this leads to central banks owning a larger and larger share of their own government debt. And the following graph shows central bank assets as a percentage of GDP. And again, the image here speaks for itself. As you can see, the Bank of Japan's assets represent north of 100% of their annual GDP. The European Central Bank is now getting close to the 75 range. And the Bank of England and the Fed are actually pretty neck and neck at the 40% range. Now, what is the end game of this setup? The end game is being best illustrated by what is happening in Japan right now. And this is the headline from yesterday. So yesterday, the Bank of Japan announced a surprise move and said that it would let the interest rate on its 10-year bond move from 25 basis points to 50 basis points. This shocked markets. Why did the Bank of Japan do this? Well, earlier this summer, when most central banks started raising interest rates, the Bank of Japan stood firm and didn't raise its own interest rates. Japan needed inflation, and by keeping rates low while others were hiking, it could accomplish just that. Now, in order for rates to stay low, however, people need to buy the Japanese bonds at a lower interest rate than the debt of the US government. So this led to a complete disappearance of the buyers of Japanese bonds. And who had to step in to buy these bonds? Well, you guessed it, the Bank of Japan. And this is why the amount of assets that the Bank of Japan holds relative to GDP is much higher than most. It's had to be buying these bonds for a longer time than every other central bank. Now, this said, every other central bank should look at itself in its Japanese mirror, as it is only a matter of time before other central banks are in Japan's shoes. Bond issuance and government debt impacts all fiat currencies. Governments have to borrow money or print the money they need to keep the lights on. And this feels like a very good time to say there will only ever be 21 million Bitcoin. And as always, we wrap up with a summary of what you can expect for the week ahead. The week ahead will be relatively light in terms of economic data that is relevant to Bitcoin and Fed speeches, as they just had their meeting last week and we're going into the Christmas holidays. But we do get personal consumption expenditures, which is another read at inflation in the US. And we do get another read at US gross domestic product. That happens on Thursday and Friday. Thursday at 8:30 a.m. we get the read of US GDP. The expectation there is to come in at 2.9%. So look for markets to celebrate a number above that, come under pressure if the number comes below. And also we'll get Friday, 8:30 a.m. Eastern, the personal consumption expenditures index. Again, the other read of inflation. The expectation here is for 0.1 increase month over month and for 4.7 annualized inflation. That compares to 0.3 month over month last month and 5% annualized inflation on the same data last month. So it seems to be trending in the right direction. Now, outside of data and economic data that gets released, other things that can move crypto markets are updates on the Genesis Capital situation and or the FTX situation. On the Genesis side, the group is still trying to avoid bankruptcy and is exploring options. And this is likely to be the biggest wildcard in crypto markets in the near term. So keep an eye out for those headlines. Now, with that, we've reached the end of today's show. If you enjoyed it, if you liked it, I welcome you to like the episode, subscribe to our channel, share it with your friends. And if you don't yet have a Ledn account, I welcome you to check us out at ledn.io. Thank you, everybody. Have a very Merry Christmas. Los quiero mucho and see you next week.